So identifying breaks in market structure, now that we've identified what market structure is, my definition is a shift in the sequence of highs and lows in the opposite direction. So for a bullish market structure break, it is when a sequence of lower highs is violated by a higher high. And of course, for bearish market structure break, it is when a sequence of higher lows is violated by a lower low. Just very quickly, I know I said that I wouldn't profess to teaching some sort of orthodoxy or this is how market structure is, but even with my pretty straightforward and simple definitions, there are some criticisms and alternative views to be aware of. So for example, you can see that for my bullish market structure break definition, you just need a higher high, right? Lower high, higher high, and that event in itself is valid for breaking market structure. There are some schools of thought which argue that the higher high in itself isn't enough, and you need a higher low before the higher high for that to be a valid break in market structure. So slightly more stringent requirements. Again, it's not the case of this person's right, this person's wrong, and this is how I do things my way or the highway. As with anything, it's just personal preference, trade-offs, and what works for you. My personal view is the requirement of a higher low before a higher high is just pretty conservative and also just more burdensome. The second kind of criticism to be aware of with regard to my definition of market structure offered in the first bullet point is that there's an alternative view that the lower high that's broken must have preceded a lower low to be valid, or the higher low that is broken must have preceded a higher high to be valid. So you can see in my definition, I don't ascribe any special functions to the higher low, to the lower high or the higher low that get violated, but some schools of thought or practitioners of market structure will ascribe certain features to these highs and lows in order for their break to be valid. Again, I think it's just needlessly complex. You can just see how simple my definition is compared to all the other caveats. Simple isn't always better, but in this instance, I feel like it's beneficial. And I still integrate similar logic for setups in terms of how significant is this high or low, but I think it's unduly restrictive, and some obvious market structure anchors just don't meet this strict test. Ethereum Bitcoin on the weekly time frame comes to mind. So this is it, right? And Donald and I in Technical Roundup wrote about the break in weekly market structure when we had this higher high on the weekly time frame. So we had this swing point, okay, and then a close above it. You can see high, lower high, and then higher high relative to the last one here. So this for us was a break in market structure, right? This bit of price action closing above the level, and we managed to catch or be prepared for the move that was to follow. If we were to take an overly strict definition that the broken high must have led to a lower low, then if we just look at where this leg down went, it technically made a higher low to the preceding one. So not much good there. And even if we take probably one of the best and most outstanding swing points on the chart all the way up here and assess whether it's valid for a market structure anchor, if we look at the leg down that came as a result of that swing, technically it didn't make a lower low either. So that would mean that this, under some interpretations, wouldn't be a valid market structure level because it didn't lead to a lower low. Again, not saying one is right, one is wrong. I just think it's unduly stringent, and I think I'll just have an easier time making this video, both with stuff that I actually trade, how I view things myself, but also building upon this as a foundation. I think we'll have an easier time. I just wanted to bring in some alternative perspectives, make you aware that if people disagree with you on the internet, it won't be the end of the world. There are different ways of doing things. I'm just giving you what works for me. And as it says in the final point, study your own trades, see what works for you. Maybe integrate mine, maybe integrate another version, both. This is, your toolbox. Customize it as you wish. Some basic home cooked diagrams for breaks in market structure, again, relying on the basic definitions put forth in the previous slide. We've got a high, lower high, and then the market structure break event is when we have a shift from the sequence of lower highs to a higher high. Right, so the higher high event for me is the break in market structure, specifically the close above a lower high. Some points, as sort of touched on earlier, what's happening at the lows is less relevant for me when it comes to bullish market structure. I want to see evidence of what's going on at resistance and higher prices to be focused on the bullish side, so that's just my view. And the same for the bearish side. or similar logic. You've got low, higher low, and again, the sequence of the shift, bearish shift in market structure is when you move from higher lows, and that's broken by a lower low. That shift from higher lows to lower low is the break in market structure, or the market structure break. So again, higher low, lower low, that shift is our MSB. Same thing, for me personally, what's happening at the highs is less relevant. If I'm focusing on the bearish side, my focus will be on lower prices and on price behavior around support for the most part, and hence why less interested up here, eyes down here. To deal with the nitty-gritty, wicks or bodies, people seem fascinated with this topic. It's not too relevant, but I'll happily entertain it. In most cases, just as a general heuristic, if you must ask yourself whether market structure break has formed, it probably hasn't, or at least a very clear one hasn't. As for wicks or bodies, there's no right answer, in my opinion, as long as your framework for ascertaining them is consistent. That is to say, ascertaining breaks in market structure. So some common variants of kind of wicks or bodies and candle closes, all that type of stuff, is using wicks to delineate market structure, and a wick above or below constitutes a break. So no requirement for a close, just wicks through swing highs, wicks through swing lows would constitute a market structure break. I've seen that. The second one, I think this is probably the most popular one, using wicks for market structure, so swing highs and swing lows, the actual wicks and the candlesticks, and then closes above the highs or below the lows for market structure breaks. This is the more conservative one, where you're using the extreme for the high and low, and then you want a full close through to get some sort of confirmation. So that's pretty popular. And then my preferred variant is using candle bodies for market structure, and then closes, so again, bodies above or below for market structure break. No magical reason, not saying this is the real way to do it, secret voodoo, whatever, just something I've done and what works for me. I was using candle closes for levels, and it just basically transplanted it to market structure, and I didn't feel hurt by the decision. But again, look for yourself, maybe your market's different. If in doubt, context will often dictate what's reasonable in exceptional circumstances. I've got the example of Bitcoin having this 14k wick, and well, was market structure broken on the 12k break or on the 14k break? Like if you have those anomalous wicks, which are clearly far away from where most of the trading was done, and the candle bodies just have the nicer levels, and like a lot of the time it'll be pretty obvious. So by all means be consistent, but no need to be a zealot with these things. You'll know a breakout and a breakdown when you see one, and if you're having to split hairs by looking at wicks versus bodies, then maybe it's not as clear-cut as you've thought. As for candle closes, as we discussed the common variants, it's, wicks above or closes above, below, etc. I'd say watch the timeframes video. Generally, it's helpful for this video as well. But as a safe rule to roll with, I at least like to see a close above or below on the same time frame as the market structure anchor. So if I'm looking at daily market structure, and I've got my swing high or swing low set out, I want to see a daily close through that high or low to constitute a market structure break type of event. Otherwise, it's just kind of a retest of support resistance or some other weird stuff, and it also just makes things very easy to interpret consistently. You're not having to look at random timeframes and weird price action. You have the market structure level from a certain time frame, and it's broken when that same time frame closes through it. Pretty straightforward, and the market, at least crypto markets, seem generally comfortable with this implied consensus around candle closes, so until that changes, I'm totally fine with it. So identifying breaks in market structure, again, this isn't focused on trading market structure breaks, which is the third section. This is more, once you've identified it, what can you do with that information, or perhaps what you shouldn't do with that information. So directional bias is a big one. I strongly recommend watching the video on, not the video, this kind of is the video, but reading the Medium article on directional bias. I'll try to link that in the description. If not, just search CryptoCred directional bias. It's a Medium article, but the basic outline is as follows. It may seem fairly self-explanatory, but of course, the upcoming slides will build on the content in the slides that come before it, so bear with me. And it's also good for beginners. So for a bullish market structure break, we're essentially anticipating a higher high with or without a higher low, right? So you've got the bullish market structure break, the higher high is formed, we're anticipating higher prices, usually in the form of another higher high, And whether it pulls back or not, hence the with or without a higher low, we don't know. But generally, that's a bullish outlook. Buyers are in control, resistance is broken, however you want to slice it, and we're favoring long side trades. And that also means that short side trades are counter trend, right? Bearish market structure break, as you can imagine, is the opposite. You have a bearish market structure break, that's a lower low, support is broken, and we're anticipating lower prices with or without another lower high. Again, we don't know how or if the market's going to pull back in those cases, and that's a bearish outlook. Generally, once you have that bearish break in market structure, assuming lower highs and lower lows and favoring short side trades, or if you're long only or in other circumstances, you could stay out, take profit, hedge, or do whatever it is you do to mitigate exposure in those cases. And as per the last point, jumping a little bit, market structure breaks don't always have to translate into a trade. It can be used, or they can be used as signals in their own right. So maybe I'm going to stop longing, I'm going to move my stops, I'm going to take some profit, I'm going to hedge, etc. It doesn't always have to be long this, short this, right? Practical considerations for trading an MSB. And this is just some quick pointers, maybe a summary version of the article, but you should still read it, on trading against a market structure break. So again, bullish break, bullish outlook, but what if you want to take bearish trades, right? Or bearish trade, bearish outlook, but what if you do want to get long? There are some things to be aware of if and when you find yourself in those counter trend scenarios. And again, all my personal views, opinions, and so on. The first of all, the basic overarching idea is if you're trading counter trend, you're trading against the current, so to speak. And therefore, you have to be more defensive and less liberal with those positions because the odds, so to speak, to use that term very loosely, are against you. What are some of those considerations, or what might those considerations translate into during a trade? Well, shorter holding periods, for one, more conservative targets, closing trades at FTA, first trouble area, greater minimum risk reward requirements, usually with closer invalidation, not wider targets. So let's say typically for a trade, you will have a requirement to offer at least 1.5 reward for every unit of risk. And then for a counter trend trade, because the current, so to speak, is against you, or the probability of that side of the market being correct or rewarding you is lower, you kind of build that in to your trade parameters and require, let's say, 2 reward for 1 risk instead of 1.5. So the payoff has to be worth it, or there has to be a higher chance of a greater payout than usual in order to justify trading counter trend. And again, small nuance point, it usually comes in the form of closer invalidation, which is much more reasonable and playing much more defensively as opposed to picking wider targets. You don't want to artificially inflate your risk reward by going for wider targets instead of looking for opportunities close to invalidation, which kind of goes hand in hand with shorter holding periods anyway. Further, more active trade management. The whole idea of letting winners run is more trend following and trading in tandem with the trend, that you don't overmanage positions that are just going up generally if you're long, etc., etc. Whereas if you're counter trend, you need to be a bit more dynamic and not allow your evolving R, so to speak, to deteriorate. So, these trades, because they're counter trend and lower probability, by definition, sort of require more babysitting. Different sizing is also another consideration. We like to bet bigger when we're on the right side or on the easier side of the market. And if we're making our job unintentionally difficult by going counter trend, that typically warrants some sort of sizing adjustment in many cases. So obviously smaller or more conservative. Just some very quick points there. You can always flip those around when trading in the direction of the market structure break, right? So if you're trading with the trend, so to speak, those would be longer holding periods, more liberal targets, maybe lower risk reward requirements, less trade management, more hands off, and larger sizing, all else considered. Just some points to consider. Still focusing on the benefits we can derive from identifying breaks in market structure outside of trading the actual breaks in market structure. This is a very useful one because I know a lot of the audience will be levels traders or paying attention to levels in one way or another. Market structure can be used to filter good support resistance levels and structures from less good ones. So it's a great use case for those struggling with level selection, be it your levels just getting chopped and not being price sensitive at all and not being respected by the market, or if you just have too many and trading level to level becomes impossible simply because you've got a level every 1%, right? So what's the basic premise? How does market structure help us find better levels? And this comes down to what can we expect from good resistance and good support, or what are some of the behaviors and types of market structure development that we can use to find good levels. And we're essentially working backwards, right? So we look for the break in market structure, and then we're jumping and thinking, where did that come from? And the origin of those market structure shifts is where we'll find our good levels. So the basic outline is as follows. Resistance, or a high that preceded a bearish market structure break, which is a lower low, is strong resistance. And support, so a low that preceded a bullish market structure break, a higher high, is strong support. To use more colloquial terms, we're essentially asking the level itself for its CV, a kind of list of achievements. Like, okay, so you've got this high, what did it actually do? Why is it significant? Why is it better than any other high? Well, this high preceded a break in market structure. So the market reached this price level and then made a lower low. Okay, well that's a bit more significant than the market just reaching that high and then doing nothing. And the same for support. Why this low? Why this support? Well, the bounce that followed made a higher high and shifted market structure. Okay, well that's a bit more significant than other levels perhaps. And this type of logic is applicable to all support resistance structures and similar stuff generally. You'll see it applied to supply demand zones. Like, this is the supply zone and the move away from it broke demand, so it's significant. Or this is demand zone, move away from it broke this supply, so it's significant. Kind of second order thinking makes sense, right? I'd say it's particularly applicable for range trading, where retests are deeper and or higher lows and lower highs are less pronounced. When you really need to zero in on like a range low or a level, this type of stuff can help. Here's the TLDR, and memorizing this is going to be important for our reversal setup. But a high that forced the lower low, forced, preceded, doesn't really matter whether you believe in the causation side of things. It's really irrelevant. It's just structure we're interested in. But a high that forced the lower low is significant, and a low that forced the higher high is significant. Again, we see the shift in market structure. That's significant, and we work backward to find the level, so to speak. Here's the home-cooked diagram version, right? Strong support. We're almost working backwards. So you've got the high, the lower high, higher high. Okay, we know that's important because the higher high is the break in market structure. That's some serious stuff. Where did it come from, so to speak? We're tracking it on Ancestry or whatever data mining website you use, and we work backwards and see this was the swing low that broke market structure to the upside, right? Or the market structure shifting move originated from here. Even if we compare it to its neighbor, let's say this swing low, okay, well that's potentially good support. I mean, I know in this case the levels are lined up, so it's not terribly compelling, but just for the sake of argument, this swing low, you got a bounce, but that bounce resulted in a lower high. Not as impressive, whereas the move from this low resulted in a higher high. Okay, now we're in business. I think the same logic can be applied to resistance, of course, whereby we're working backwards. We see this shift in market structure, low, higher low, lower low. Okay, something clearly happened here. This is significant, the shift in behavior, and let's work backwards. Where did this lower low and market structure shift come from? And this is the high that preceded the market structure break, or again, to use that type of language, the market structure shifting move originated from here. It's like, well, what did this high do? Yeah, it led to a sell-off, but it was a higher low. This is the one which shifted market structure. So the level kind of derives additional significance from the fact that it moved things around a lot. This is an important bit, identifying breaks in market structure with regard to entry triggers. And market structure breaks can be used as an entry trigger, or MSB can be used as an entry trigger when trading at, and in brackets, high time frame structure. It doesn't have to be high time frame structure, but that's the most common use case. What's the basic premise? Well, this seeks to address the common question of, well, how do you know this support's going to hold? Or how do you know this resistance is going to hold? Which I think is generally impossible to answer. And the answer itself is actually quite boring as well. You don't. So, you either take a guess or you develop a case based on evidence in price action as it develops, right? Or you just go in with no knowledge and the risk reward and the payout and the probability, etc., justify a blind entry. But for our purposes, if we simplify things a bit, how do you know the support's going to hold? Well, what would be good evidence of support holding? Well, a bullish break in market structure would mean that buying is going on at the level. So, that's pretty good confirmation as far as those things go. Same for the bearish side. How do you know this resistance is going to hold? Well, if markets, I don't know if it's going to hold, but if market structure starts to break down, then that's good reason to believe that sellers are selling the level. So it's doing something. So I don't know for certain, but at least it shifts the odds in that direction and in my favor. So the basic premise: bearish market structure break at resistance for sell setups. We want to see selling at resistance. Bullish market structure break at support. For buy setups, we want to see buying at support. It's most commonly used in multi-timeframe trading systems. So this is your kind of top-down stuff that you'll see pretty frequently, whereby you'll start with the high timeframes, like weekly, daily structure, as an area to do business. Like this is the support I want to buy, resistance I want to sell, usually based on, again, high timeframe levels, structures, what have you. And then there's a low timeframe market structure break as the trigger for the trade. So this is the daily level, and I'll get the hourly lower highs and lower lows. That'll be my entry to short. Or this is, daily support. I'll wait for 4 hour lower highs, 4 hour higher highs and higher lows, and that'll be my trigger to buy. It's important to note that this time frame logic is often scaled down. So you'll see 5-minute, 15-minute entries at even intraday levels, and it's more the hierarchy of timeframes that's relevant, that you derive clues about higher timeframe structure from the price action, specifically market structure on lower timeframes. Some important notes, and this is something I've been thinking about a lot, both just throughout my career and also the people that I've learned to trade from, etc., and I think it's relevant for developing traders. The idea of confirmation tends to be a golden goose for most people, and it's much easier said than done. I've seen a very small handful of people actually integrate it into their system, Trader SZ being one of them. Go watch his live streams and learn from him, but he's been doing it for, at least 2 or 3 times as long as I've just traded my first market. So there's a lot of experience that goes into that, and he's also incredibly systematic, and he knows what in advance, in very clear, unambiguous terms, what confirmation means, how to use it, when to use it, and the implications it has for his trading system, how it affects his entries, etc., etc. So it's no joke, it's no easy no kind of laughing matter, right? And of course, it stands to logic that if confirmation in trading were easy or accessible, losing a trade would be very difficult, because you'd have a level, and if it confirms, great, you get on board, you get the trade, and if it doesn't confirm, well, thank God, because you missed out. You dodged a bullet on the losing trade. Of course, in reality, it doesn't work that way. My observation, certainly with beginners traders, is that most participants end up being their own greatest enemies in trying to develop a confirmation-based system. It's just searching for certainty in a business where the certainty comes either at a premium or just doesn't exist. And how many times has this happened to you where you've planned a trade, like this is the level, I'm going to buy it, the market comes into the level, you get a bit scared or antsy, you try to outsmart yourself, you start looking at other time frames, other indicators, etc. By the end of it, you've opened the close and trade 20 times, and the result, of course, is your original plan plays out perfectly, just bounces, and you would have had an easy time just either leaving a limit order or hitting a market order as soon as it hit the level. So there is that risk that trying to outsmart the market in that way, certainly using a lot of discretion like that in execution as a beginner trader comes with its own risks, and there's often just an implicit trade-off with the whole idea of confirmation, if you even entertain it, which is that you'll get good confirmation and a shit entry versus little to no confirmation and a great entry. Not to mention that if you have to wait for confirmation for a lot of trade setups, it will lock you out of some of the best entries and trade types, especially on lower time frames. So that's something else to be aware of. You kind of cut off the potential scope of opportunities if you always have to wait for XYZ to develop. Not to mention that if you really get into granular intraday trading, a lot of the time what you think is market structure developing, etc., if you get really granular, will more likely than not just be noise. And, just a couple of big market orders being able to push around your entry trigger system probably isn't the best thing in the world. Perhaps most importantly, there's a risk of creating a poor habit of what's essentially only entering a market once it moves significantly in your favor. And I've tried this. I've tried to develop systems which give me, certainty even at the expense of entry, and those haven't corresponded with great parts and great periods in my trading career. So just some nuances to be aware of. That said, it's not like it's a useless tool, and there's a reason I've included it into the presentation. My preferred approach with regard to using market structure is to essentially preview high time frame price action. So I'll use daily market structure weekly levels, for example. Instead of having to wait a whole week for a candle to close at structure before getting any sort of information as to whether support or resistance is going to do its job, using daily market structure at these higher time frame levels is a pretty good middle ground compromise to get something faster moving instead of waiting, 14 to 21 days to enter a position. And also just generally, and this is especially relevant with Bitcoin at above 20,000 with no real levels left. Using daily market structure on its own when the market is between levels is helpful, and generally just for low time frame trading to provide context, very useful tools. But I certainly wanted to touch on that note of confirmation and maybe point out some potential difficulties to be aware of.